What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, I'm going to give you some analysis for pretty much where I see the stock market going, what I did with some of my stocks today, some information and research to support my hypothesis, and just kind of break down, what I'm doing and where I see the market going. So, let's start with here is the QQQ. Okay, so I sold about 20 shares of this today, and I'm going to tell you why. But there's a lot of reasons. But I sold about 20 shares of this. For one, I was very heavy on this position. Number two, I was very low on cash because I had pretty much gone all in ever since the crash we had 4 or 5 months ago. So I was very happy. As you can see, I have lots of shares of this. So I was more than happy to take off 20 shares. 25% gain in 4 or 5 months is very good. I was very happy with that. And now I have more cash. Now I feel better if we have this dip or this correction that I'm expecting to have probably in maybe 3 months, maybe, 3 to 6 months. It could also just be that the market will just be flat. I see a combination of those. I can see a 10% correction mixed in where for several months the market is pretty much flat. That's how I'm kind of seeing this. So let's get started with my first point. Here is the top 10 holdings for the index, okay? More than half of the index is made up of just these 10 positions, even though there's actually only 9 companies there because there's Google on there twice. But let's say with those 9 companies, I looked at the valuations and the P/E ratio of all these stocks today, and only like one or two of them is, you know, like I would say, like Google just reached fair value. And so from here it could, stay there, go up, go down, who knows. But a lot of them, Nvidia is like okay, like Nvidia is just where it normally is. So that one's fine. But Tesla is just ridiculously high. Just it just looks stupid on how high it is. It's not sustainable. Even Broadcom is not one that I look at a lot, but look at the P ratio for Broadcom compared to where it normally trades. Yeah, see, so it's this is such a weird one. So Broadcom traded from a 50 down to a 17 for several years. It went all the way up to 137, and now it's back up to an 88, right? So that's very high. But pretty much the point here is that all these stocks are trading on the either at fair, they reach fair value or they're on the higher valuation side of things. And so, in other words, there's not a lot of room for these stocks to keep running. And for a couple of them, like a Tesla, it's we're way past due for a giant crash in a stock like Tesla, where it's pricing in years and years of earnings growth, and it's just that one just looks stupid. And that's coming from me who was Tesla is like my best investment of all time, and I used to be, all in for the company, and I used to be the biggest fan. But in terms of investing in it, it does not make sense in the last 2 years or so. Um, what else have we got? Then we got this chart here. So you go on Yardini Research, they have all these different charts for stuff. These are charts showing the PE ratios for several different things. S&P 500, the mid caps, the small caps, and the Mag 7. So, the big one here really is the large caps, the S&P 500 and the large caps. Those are what stand out to me because look at that red line. That is what is extremely high. Now, you look at 2000 to 2014, and it's a we're in a bit of a different game now. I would say the environment is we're in a different position, different place. I would not, I wouldn't say, oh, if because we're at the 2016 high, that means that we're at, relatively high levels. I think we're in a different ballpark now. So, but with where we're at right now for this red line, look at how high this is. This is the highest it's been in over 20 years, right? We're going on almost 25 years, and the only time it's been this high is right after the pandemic crash. Okay, so that's the first problem. Now, as you can see, the blue and green line is not really a problem. That's mid caps and small caps. Those are not really a problem, so that's fine. So what that kind of says is that the money could move from large caps into small caps. But to be honest, the large caps make up the majority of the market. Like we just looked at with the triple Qs, it's mostly those ginormous companies that are worth $1 trillion and up. So that's how I kind of see it. I see a lot of stagnation that's going to happen with the market. Like I said, if valuations are where they're at, although there's positive catalysts in the the economy and in the market right now, such as the Fed cutting rates, um, AI integration through with every single company out there practically. Those are positive catalysts, but the companies can be progressing and growing earnings while the valuation goes down, right? Or the valuation stays put. That's where I see the stocks not being able to move enough. So that's why I just think it's smart to take some profits off of some of these big gainers. I mean, Nvidia is let's look at Apple. I want to say Apple is it's just these stocks have reached their fullest potential pretty much, and this year has been incredible, right? Forward PE of 30. Okay, so for Apple, that's like kind of right in the middle. Um, Microsoft is one where it's high. Microsoft, it's time for this one to come down. Let's look at there, forward PE of 33. So that's the highest it's been that's typically on the much higher side of things. So let's just keep this video short. If you guys have any questions or, comments, arguments, concerns, comment down below and tell me what you guys think. But I mean, this is just, I feel like there's a good amount of evidence to support this thesis. I mean, the P ratios just look high, and who knows what's going to happen with the tariffs coming up and the rate cuts and stuff. The rate cuts are good for the market. That's great. AI is good for the market, but the tariffs are who knows what's going to happen. That changes like every other week. But the main thing is just the valuation. Look how much these stocks have ran up. The market is up over 50 the market's up 50% just from April. From April to now, the market's up 50%. This was $400 and now we're at 600. That's insane. So, these periods don't last forever. Now again, I like to bring up these statistics. Once every 2 years on average, we have a 10% correction, and once every 8 years or so, we have a crash where it's, we're talking maybe 25, 35%, something like that. So there is that. And since we just had this big crash here and this really big crash here, I don't see us having a 30% crash. I see us having a 10 or 15% short-term dip. And also, I mean, sometimes you have a year where the market's pretty much flat. So I think that's realistic too. That's why I'm taking some profits just so that I got some cash ready when those stocks crash, and then I could take advantage of that. So that is my opinion. Let me know what you guys think, and I will see you in the next video.